Good morning and welcome to today's Monday morning market update, where, of course, we'll be breaking down some of the key headlines from last week and what they mean for you and your investments. I'm just sharing my screen, so hopefully you can now all see that, which is, of course, this week's presentation. Now, if you do have any questions whilst you're joining here live, you can always ask in the Slido link, which I'm going to share just shortly. Within that, you can ask questions with your name anonymously. It's totally up to you. There is no such thing as a silly question in our book, so do feel that you can ask whatever it is that you might have in mind. And of course, if you're watching this recorded afterwards, you can always drop any questions that you might have through to us at hello@myfinancialfreedomcoach.co.uk. And on that note, this is recorded as well, and we do our very best to distribute the recordings afterwards, so do keep an eye out for that. It's a nice, simple YouTube link, so if there is anything that you missed, you can always come back to it as well. And last bit from me on this bit of housekeeping is that whilst it is recorded, as I mentioned, and of course you can ask any questions whilst you're going through, if you do see anything in the headlines in the week that you're like, oh, I just love that to be broken down for me a little bit further, or of course if you see something that you know perhaps directly impacts your investments and you want us to dig into because it's related to the news, then again, just drop us a message either on Instagram or on our hello@myfinancialfreedomcoach.co.uk, where you can ask away. So without further ado, I will leap into what we're here for this week. Today's Financially Speaking, your Monday morning money briefing. So if you're new here, hello and welcome. If you've been to a few, which I think some of you have, I've got some familiar faces out there, which is great. Then I'll be going through one thing I've done this week to get that little bit closer to financial freedom before going into what's happened in the UK, the US, having a look at a read of the week, Europe, and the rest of the world as well. So one thing that I have done to get a little bit closer to financial freedom is, and hold breath everyone, I've looked in on tax. For us in the UK, it's coming up to a really big deadline, which is the 31st of January. 31st of January is the last day that you can file your self-assessment tax return. So the reason why you'd file a self-assessment tax return is if, of course, you're self-employed, but also if you've got earnings or income coming from anywhere else. So if, for example, you've got investments held outside of an ISA or a pension, if you've got, for example, a property, if you've made money from any other form. So if you've been selling things, for example, and it goes over a certain threshold, and you can always check those thresholds on the government website, then you'll need to report it via self-assessment. Now, this is just in the UK, but of course, every country has their own tax deadlines. And when you are investing, it's always super important that you stay on top of whatever deadlines it might be that you need to meet, because often going beyond those deadlines comes with certain penalties. For example, in the UK, if you go beyond the 31st of January, it's an immediate £100 fine. And then if you keep delaying it, it goes up and up and up. It's not much fun. So the moral of the story is get your head out of the sand and make sure you're aware of what's going in with tax. And it's perhaps a case of practice what you preach, because tax in the 2 weeks in the run-up. Well, the good news is I was double checking whether I had filed it, and I've been clearly so organised. I'm blowing my own trumpet here, but of all people, I feel like I should be. I'd actually done it earlier in the year. So the good news is I've not got a last minute dash to sort it, and it's all done. The system does make it now and nice and easy now as well, because it saves things. So if you do think you've got a self-employed self-assessment tax return to do and you're in the UK, get in now before we're in that mad rush right at the end and the HMRC helplines are absolutely chocker and you're on hold for hours. Do have a look in on it. And remember to be super organised, to keep your stress levels low in the future as well. I did have a minor panic that involved a text to various different people to check in on things until I found that I had indeed done it. So let's take a look then at the markets and how they've performed in the last week. It's been a really interesting week again. I'm absolutely loving bringing these market updates to you because there is just so much going on at the moment. So the FTSE 100, which is a measure of the 100 biggest companies in the UK, ended the week up in the positive by 1.09%. The US indices did not fare quite so well. So the S&P 500, a measure of the major 500 companies in the US, was down just ever so slightly by a whisker, by minus 0.6%. The NASDAQ, which is usually the tech-based index in the US, was also down by 0.26%. The Euro Stoxx 50, meanwhile, did climb so slightly. That is the measure of the 50 biggest companies in the Eurozone, and it was up by 0.57%. So, how you can sort of read this? Well, many of us will have looked at some headlines throughout the week, and they've certainly been dramatic. From, for example, ongoing talks of tariffs. We've now got Greenland on the cards as well, being spoken about from Trump. It can feel quite dramatic and quite doom and gloom. Actually, what we see with these market readings once again is that the headlines do not always correlate with what we then see at the end of the week from those markets. So try and separate the two wherever you can. I think often I speak to people and they go, "Oh, it must be a terrible time," when actually it can often be the other way. And sometimes people can do things like put off investing. Sometimes people can put off looking at their portfolio because they've seen the immediate headlines of the news they read and they think, oh gosh, it must be really bad. Things are not looking good at all. And as a result, what they do is they perhaps make decisions that don't necessarily serve them in the long run. So don't always match up those headlines with what is going on in the actual markets. So, what has happened then in the UK? Well, there's been some reports around income tax, notably that more than 5.5 million people in the UK overpaid their income tax. This works out to be at around £3.5 billion in income tax between the years 2023 and 2024. This is mostly due to the fact that PAYE codes, so when you're employed, you're what is known as PAYE, standing for pay as you earn, and you get given a tax code, and you'll be able to see this tax code on your pay slip. Now, sometimes there are errors. Sometimes people get the wrong codes. Sometimes there is difficulties if you change jobs, for example. And there can just also be general errors. There's a lot of people living in the UK and the system is a little bit outdated. There's also growing tax complexities, which can mean that people end up in the wrong place with the wrong code. So, what does all this mean then for you, your investments, and well, actually your finances as well? Well, these overpayments, of course, expose some real inefficiencies within the UK system. I remember from having worked in a Danish company, the Danish system is so slick. They all log on one day and they all find out exactly how much tax they're going to be owed back. And there's very rarely any errors. There's no point comparing. They have a totally different country, a totally different demographic makeup, and of course, a totally different size population to what the UK have. But what it does show is that if people now see this stat and see they're overpaying tax, most people aren't going to be superbly pleased about that. And of course, paying more tax means reducing the amount of disposable income people have. So what that means is that they've not got as much to spend and not got as much in their pockets as they may otherwise have. But the good news is, of course, that the governments earn a little bit more. So, what this really highlights for me more than anything is it's so important to stay savvy on your tax position and your tax codes. Wherever you are in the world, whether it's the UK or elsewhere, make sure that you're paying the right amount of tax. I often break it down because I don't even find tax, the actual administration of it, that exciting. And so it's a task that can be put off because it's not exciting. There's always more interesting things to be doing in life. But what that can mean is some pain in the long run if you're losing money, overpaying, or potentially due fines if you don't do the right thing. So break it down into bite-sized chunks and do it in a way that works for you. But make sure that those tax codes are not disadvantaging your overall financial situation. Because the more money that you have in your pocket is the more money that you have in your power for your future and for growing your wealth as well. So, over the pond in the US, then, where one of the major headlines is a little bit more niche, and that's why I really wanted to dig into breaking it down. It's been all about how private credit investors withdrew over $7 billion from major Wall Street funds. Now, private credit investors are kind of a halfway home. They're somewhere between banks, investing houses. They serve lots of different purposes. But the headline here relates to the fact that these private credit investors, notably those in automobiles and cars, have withdrawn a lot of money due to their fears around the bankruptcies of two major companies, First Brands and Tricolor. Now, one of these companies is an auto financing company, and one is for car parts, so both relating to the automobile industry. Now, if you think about that industry, no matter where you are in the world, you'll probably be aware that it's kind of one that you can relate to. Car financing is where normally people go and they pay a certain amount every month to be able to have a car. Now, with that car financing, what that means is that essentially they're going to some sort of third party who's lending the money, and they normally pay quite a high rate of interest. But there aren't often the same level of checks as there would be with, let's say, a mortgage, a much bigger loan, or indeed even other loans, such as business loans, maybe even student loans, depending on where you are. Often car loans are pretty easy to get because you don't necessarily need a super strong credit score, you don't need to have a great history or anything, they just get given out. But what this means is that when lots are given out within the system, and then therefore potentially lots of people are not able to make the payments and default, we have a situation where companies can end up going bust because more and more of those loans default and they don't get the money coming in that they expect. Now, if any of you have read into the 2008 economic recession or seen, for example, The Big Short, then you might be thinking this is ringing some bells. This is exactly what happened back in 2008 with mortgages. Mortgages were being given out in particularly the US to people who were not able to make the payments, and a lot of them defaulted. And this began a little bit of a toppling, and the house of cards all fell down within the 2008 recession. Now, it's not to say that that is exactly what this is leading to, but it's certainly an interesting headline to have emerged, or at least gone under the radar a little bit from last week. Because actually, these private credit institutions withdrawing is an important signal for what is going on in some different investors' minds. This is not the likes of you and I when we're talking about investors. This is another layer removed. This is lenders, and this is signaling their caution. It can potentially mean as well that there's going to be a tightening of financing within certain sectors. So, actually, what that could mean is that some businesses are not able to get the loans that they were hoping and therefore might not grow in quite the same way. Might also mean that some individuals aren't able to get the loans that they were hoping for and therefore won't necessarily be spending in quite the same way, even in the short run. And what that can lead to is just a bit of sluggishness within the economy. So, what does all this mean then for you and your investments? Well, this is kind of a watch from afar situation. It's one that we're thinking where, okay, let's, take a look at this and really see what is going on. There are some people signaling a little bit of caution. It's not the end of the world. It doesn't mean that we should move away from sectors like automobiles or the US. Can't really move away from private credit, but it's certainly an indicator that there might be some shifts under the currents, if you like. I think of it as like a sea. Then actually, what is going on is, slowing a little bit perhaps, and certainly showing signs of caution. So for your investments, that key has really never been bigger to be diversified. It's just saying, watch what's going on, remain diversified, and wherever possible, remain calm. There's a lot of things going on at the moment. This is just another one in the mix, and one that we can keep in the back of our mind, but not necessarily make any big changes off the back of, but certainly know it's there and kind of what it might be doing to our investments as well when there is a bit of caution in the air. On to then the read of the week, where the Financial Times were digging into the single tax and crucially, how much it can hurt your investments. So the article really highlights how those individuals who are single can face harder financial times than those who are in a relationship. So the article goes into things like how higher rents, tax pressures, as well as perhaps smaller housing options and greater perceived financial risk can all compound over time. What this can do is widen the investment and retirement gap for singles. At least that's what they found in this article. But as one person households are set to become more common, and indeed already are more common, is something that really needs addressing on a wider, more societal and strategic fashion as well. So if you are sat there single this Monday morning thinking, flipping it, great, that's all I needed to hear, just another thing to add to the mix. Actually, for me, what the takeaway from this read of the week really is, it's a sign that A, if you're already here on this Monday morning listening, then you are taking charge of your investments and your financial situation, which is fantastic. Keep going at it. No matter what your situation, there's always going to be bits that are trickier. And if you're aware of them, often you can take charge of them and hopefully as well try to mitigate them wherever possible. So if you are single, for example, it may well be that you do face some of those issues. So wherever you can, plug the gap, invest that little bit extra, take a look at some extra strategies that you can use to be super savvy with tax, whatever it might be. In the UK, for example, if you do live alone, often your council tax is a little bit lower than those living in 2, 3, 4 person households. So check in on that kind of thing and make sure you're taking advantage of it, because there's no point suffering whatever the situation is if there's things to be there. So let's take a look then at Europe, where first up, Donald Trump said he would impose 10% tariffs on several European countries from next month. This is all related to the growing area of tension over Greenland. Various different European countries have expressed their displeasure at Donald Trump's desire to take Greenland, which is currently a territory of Denmark's, of course, a member of the European bloc. And therefore, what this has done is just added further uncertainty into the markets. The tariff threat is there again. We're back here again. And it pressures various different sectors again. Things like export heavy stocks and also various different assets that could potentially really suffer from a 10% tariff being whacked back on. Of course, there are always winners and losers. So the safe haven assets, the likes of gold and silver and other areas as well, saw a bit of a boost last week because once again, that volatility is back and certain stock markets have got jitters off the back of it. It's not going away. Something tells me that this week he's not going to suddenly change his mind, but who knows? We've seen him go back and forth, flip flop, roller coaster through various different tariff decisions over the last year. So brace yourselves and hold tight for 2026 tariffs once again. That word is not yet over. We're still talking about it and we're still holding on. But if you have been listening to these Monday morning updates for the last year, as we've been talking about tariffs, and also watching your own investments through that time as well, what you might well have seen is that whilst I'm here every Monday morning talking about tariffs, and it's all we can see in the headlines, and it feels at times a bit bleak, actually what we're seeing is that it doesn't always reflect in our investments. Many investing areas had record years last year. So despite those tariff threats, things still looked relatively good in some areas. So don't give up hope. And onto then aerospace and defense. Off the back of the announcement of this conflict, of course, there are always winners and losers. And one of those winners at the moment is defense stocks, notably European defense stocks as well. Over the last few decades, even indeed longer than that, often what Europe has done is turn to the US for their defense sector. But with increased military spending in various different nations in Europe and an increased focus on that coming from European counterparts, given the tension that is currently taking place between the US and Denmark, and of course, therefore, other European nations, actually, the European defense sector has seen a real boost. It surged at the start of 2026 with the Stocks Europe Aerospace Index, so that's just an index of specifically European defence companies, being up already by nearly 15%. It's nearly 1% every day for the year, which is kind of wild when you think about it. This is helping to boost regional markets, and it's also drawing investment towards more domestic sectors. But it may well mean that, there could be other areas that suffer as a result, things like cyclical or more consumer sectors. So when you're thinking about your investments, if you've got shorter term in mind, people might pivot towards this. But often the wiser move is that long run. Given that we know so little of what is to come, jumping on board this kind of trend doesn't necessarily serve, but it's certainly one to be aware of and to keep an eye on. And onto then the rest of the world, where first up we saw the EU and South America's Mercosur bloc have signing a landmark free trade agreement. This is after nearly 25 years of talks, and it's one of the biggest trade agreements that the EU has made with regards to a reduction in tariffs with any of the bloc across the globe. This should really open some channels of imports and exports between the two areas and hopefully give a bit of a boost to various different supply chains as well. What we've seen over, let's say, the last 5 years, from COVID to the conflict that picked up in 22 with increased oil prices, to now the ongoing geopolitical tensions that we see, actually what the world is after is more and more stability within supply chains. Normally, the more diversified that is, and the further it spreads, the better it is for all involved. Which also then brings me on to the next point, which is that Canada and China have agreed to ease their trade barriers, with Ottawa, so the capital of Canada, also cutting tariffs on Chinese electric vehicles. Beijing, in turn, agreed to reduce their levies on Canadian canola. There's been a bit of a back and forth here and a bit of an agreement that actually there will be a reduction in various different tariffs that have been in place. Once again, boosting supply chains for both sides, boosting trade in various different areas, and opening doors. What we've seen with Chinese electric vehicles is that they're really growing in popularity. In fact, it was just been this year that Chinese electric vehicle maker BYD overtook Tesla in the amount of vehicles that they were producing. This is not necessarily a major feat because they have a huge domestic market, of course, with the population of China, but it's certainly part of their aims to expand more globally. And with the models being seemingly much more affordable than what we see of the Tesla, if they can get them to be more affordable with lower tariffs and increased trade agreements and a little boost to that, then really it just goes to show that some of those sectors can take off. So, what does this mean then for you and your investments? Well, again, it's one to watch in terms of different geographical areas that you may well have in your portfolio. As barriers come down and trade agreements go up, this can be a boost to various different areas. And opening of doors can mean that certain nations and certain geographical regions can really see a bit of an uptake. So, if you are looking for different geographical regions to add into your portfolio, or indeed already have them in the likes of China and Canada, then it may well be one that you continue to watch. And last but not least, with Japan, where we saw Mitsubishi Corporation announcing their acquisition of Aethon, which is the largest privately held US shale gas producer. This is quite a big move for a Japanese company. And it's also, again, another shift within various different natural resources and oil as well. So, what does this mean then for you and your investments? Well, thinking about that geographical diversification, if you've got investments in Japan, boy, have they seen an absolutely whopper takeoff in the last few years. Japan had languished really since the kind of 80s, almost 40 years of not much to write home about. That's really pivoted and changed. And this again just shows how Japan is going from strength to strength and really increasing and improving their overall global acquisition front, actually taking on board other areas as well, such as this shale gas producer, which really diversifies their overall opportunity for growth too. Japan is, without it goes without saying, an area to watch if it wasn't already. And it just adds in the argument for that greater geographical diversification wherever you can get it within your portfolio. So hopefully that has been a good roundup of last week's headlines, and you've really got some of the key ideas as to what that means for you and your investments. I'll come on now to see if there are any questions coming into that Slido link. I'll share the link again. I did just pin it in the chat, but if you do have any questions, feel free to ask away. If, of course, there is anything that comes to your mind afterwards, as I mentioned, do feel free to just drop us a message on hello at myfinancialfreedomcoach.co.uk, or of course find us on Instagram. You'll see us there. Now, if you do hop onto our website as well, you'll be able to see a wait list for our group coaching sessions, which I've been talking about recently. We've got a sign up waiting for that. We'll have maximum of 12 people in each group coaching session, and it's really about accountability. We do, of course, offer one-to-one, which are fantastic, but they kind of work in different ways. One-to-one, of course, just you and me, or you and the coach. And normally what that means is working through various different goals, strategies, areas that you need to work on within your financial situation. Now, within group coaching, it's very much the same, but you've got that accountability. You've also got other people to bounce ideas off. And I tend to find different personalities just work in different ways. For some people, that's super appealing. For others, it's less so. But you can sign up to our first ever, to be on the wait list for our first ever group coaching on our website just there. And of course, if you do have any questions about it, you can always find on the website as well a little link to a 15-minute intro call where you can chat to one of us about what any of our sessions may well mean for you, how they work, and of course, how we work here at Financial Freedom Coaching. So don't hesitate to do so. I promise we're all super friendly. Hopefully you see that from these Monday morning updates as well. But we do our best to answer whatever it is. I can't see any questions coming in. Hopefully that means that all the questions have been answered, which is always fantastic. So I will leave you to your days. Have a lovely Monday and a great week, everyone, and I'll see you all soon. Bye for now.